Mr. David Bruhan. Mr. Bruhan is Vice President and Portfolio Manager with Gregory J. Schwartz and Company in Bloomfield Hills, Michigan. For the past 21 years, he has managed retirement plans and individual accounts for high net worth clients. Mr. Bruhan received his Bachelor of Science degree from the United States Military Academy at West Point and a Master of Science in Finance degree from Walsh College. Following completion of airborne and ranger training, he led soldiers as an officer in the United States Army. He served as B Troop Commander in the 3rd Armored Cavalry Regiment in Operation Desert Storm. And David, we thank you for your service to our country. Bruhan has taught graduate courses at Walsh College and has published in the Wall Street Journal, the New York Times, Barron's, the Detroit News, Infantry Magazine, and the Marine Corps Gazette. He has lectured at West Point, Georgetown University, and Hillsdale College. He has appeared on Neil Cavuto, NPR, or as they call it, National Public Radio, and Woodward Radio. He has briefed Vice President, members of Congress, and the United States International Trade Commission. His recently published book entitled Spread the Wealth, More Haves, Fewer Have-Nots, continues to educate and enlighten every new reader. Mr. Bruhan has chosen for his presentation the following title, A Global Overview. Let us give a round of applause for Mr. David Bruhan.
A warm, sincere thank you for coming here on Saturday morning in the snow. It means a lot, and it goes to the grand strategy of these symposia, really twofold. First, to assist in developing in you a critical thought process to guide our elected leaders in making sound public policy. And second is really to stimulate your imagination to ask the right questions. It's really not the right answers, to be blunt. Any idiot can give the right answers. But if it's the wrong question, you're not going to get anywhere. My biggest concern as a generally informed citizen here in the 21st century is the plight of the poor and the middle class, which is getting worse, not better. So I'll end the lecture on addressing a little bit of those issues, but I chose the topic of global overview to give myself the ability to talk about whatever I want. and as many libertarians out there, you'll appreciate that. So I just want to let you know where things are going, and my guess, and it's only a guess, you get a lot of folks on CNBC and Bloomberg and all these high and mighty economists, and everybody's guessing. So this is my guess. Okay, so where are we with respect to the capital markets? The Dow Jones Industrial Average, and for those of you who are investors hoping that this thing works so you don't have to be farming at the end of your career, the market was down about 8.5% on the big board, the Dow, the S&P about 7%, NASDAQ was down 2.5%, the Barclays Ag, which is a broad index of bond funds, or bonds rather, was up about 1%. Now this is the end of Q3, and it gives to, especially in retirement planning, which I do for a living, why you don't sell low. Because if you fast forward, another 2.5 months, the markets have generally recovered, and they follow a pattern that happens every summer that I'll address in a minute. But this is the most despised, hated, and feared bull market in U.S. history since the Great Depression. People hate this thing. In general, most retail investors did not get back in after 2009. The pension plans, the hedge fund managers, and a lot of the big institutions got in 2010, 2011, and are fully invested to the point that their charter or prospectus allows. But usually you look at 4 major, factors or indicators if you think that we're headed for a recession. The first is investor euphoria. Sir John Templeton, who founded the Templeton Organization, a brilliant value investor who learned how to buy from his father, who bought Tennessee real estate during the Great Depression, he was a definite Graham and Dodd buy low type of person, said that in a business cycle and as markets are concerned, you generally follow a pattern. And that bull markets are born on skepticism, rise on optimism, and peak on euphoria. Well, there's no optimism and euphoria at all. This is not 1999, and it's not 2007. Many equity or stock-based mutual funds have been in outflows for the past 12 months because everybody thinks this thing is peaked, which means to me as somebody who's counterintuitive often that the old adage is right. Small investors and the general public are always what? The last to know. So this thing could have legs. Corrections are usually preceded or move in conjunction with Federal Reserve rate hikes. Well, everybody's been wrong since 2011. Fed will probably raise rates, but they're going to do so in a manner that's both staggered and very transparent. This is not Greenspan's Federal Reserve. Well, you need a PhD just to open the book to figure out what he said, and then what they used to say about policies and what was going on in the Middle East in the 80s. Once you figure out what's really going on, you have no idea what's going on. And that could be said about Greenspan's Fed. What do these minutes mean? Excessive stock valuations. Well, the market in general over 60 to 80 years trades about 16 to 18 times earnings. We may be a little high at 19 or so, depending on what index you're looking on, but we're not where we were in 2000 in the dot-com bust. And earnings support valuations of stocks, and the market has earnings. This market, these major corporations have earnings, okay? Nobody can get a raise, and that's a different topic that I'll address later. You've got a normal yield curve, all right? You give our Treasury money for 3 months, they're not going to pay you at all. You go out 10 years, you're getting about 2.1, 2.2 on the 10-year, the benchmark. And the 30 years probably in the upper twos. So you've got a normal yield curve. Usually, as Professor Greiserwald taught us when we were students long ago in a galaxy far away, that an inverted yield curve is like red sky in the morning, sailors take warning. Okay, when you're more concerned about your short money than your long money, we're headed into recession, and that was never so true as it was at the end of the 1970s, where you didn't care about the 30-year or the 10-year. You're worried about what's going to happen in 3 months because prices were going up so fast. We've got a fall market rebound in the capital markets. So you had, for different reasons, it's often been said that history does not repeat itself, but it rhymes. So markets follow a pattern, and it has to do with capital flows, a lot of it. Similar to a business cycle. The business cycle in this country and in most countries follow the supply and demand of credit. Markets are the same way. To use a medical term, you get a bolus of money, a big shot that generally goes in the market between November and May because of corporate bonuses, tax refunds, and IRA contribution. There's an adage in our industry that you could sell in May and walk away because things will be bad until October. Guess what? For different reasons, in August the market tanked because China devalued the currency. You had a slight uptick and what's known in charting as a retest of those lows on a particular Friday. And the Dow Jones Industrial Average was down 200 points. At noon, it recovered up 200. That was your spread. The bottom was in, and we're off to the races. Follows a very interesting pattern, but if you look at charts, you can see this. A lot of volatility. August is usually a lousy month. Everybody's on vacation. In Europe, literally everyone is on vacation. Having lived there for 3.5 years, you could walk into a store with $5,000 to buy furniture. At 12:01, they would tell you, come back at 2, we're going to lunch. It's like, but I got this money. We're going to lunch. Okay. All right. That's what they do. This is all good, though. It's all good. Global challenges remain. We've got China that devalued. A lot of folks are of the opinion that China devalued because because they wanted to export their way out of the economy by making their goods and services cheaper. There are some of us that believe that they were in a free fall with respect to currency leaving the country. So by devaluing the yuan and make it more expensive for people to convert into a currency like the American dollar, was a form of capital controls. For those of you, and I know you're all into it because you're here, if you want to make notes or go to the Treasury website and look at foreign holdings of U.S. Treasury debt. I didn't want to put all this up because you probably couldn't see it, but just make a note, get your crayons out, and look at the larger countries that hold U.S. Treasury. First maintains its place as China. I ran this a couple days ago at $1.27 trillion. So when Donald Trump says, well, you know, we're going to hammer the Chinese, you better be careful there, bud. They're buying your treasuries, they're loaning your money, and they're your what? Customer. The Chinese are your customer. You can't declare war on your customer. Okay? They would upset the market severely if they didn't buy your treasuries. I'm not stupid enough to sell them all because the price would be chopped in half. But don't yell at your business partners, sir. You may be great in real estate, but you're a lousy on trade. And remember, free trade means peace because you don't declare war on your customer. Second is Japan. And then about 9 or 10 down is little Belgium. Now, believe it or not, until February of 2015, Belgium was the third largest holder of U.S. Treasuries in the world. And all of a sudden they dropped. Why? Well, some of us believe that if you search the internet, it's not confirmed because it's only hearsay, but China and Switzerland was acting as brokers for who? China. So China actually has more debt than we think. When stock markets correct, we had a wicked correction in August. I mean, I manage money for a living, what's left of it after 2002 and 2009. I was surprised that our treasury market, the yield didn't tank to 1.5 or 1.6 because, you know, interest rates and bonds are inversely related. So in a correction or a catastrophe, the market around the world does one of three things. It goes to gold, it goes to the dollar, or it goes where? Students? U.S. Treasuries. So wouldn't you think that everybody would be buying treasuries, the yield would go from 2.1 to 1.7? No. Why? Because China sold treasuries. They dumped 100 or 200 billion on the market. It was absorbed. Interest rates stayed flat. And what did they do with that money? They put it in their stock market to stabilize it because it was growing. Just a guess on a Saturday from me to you. But develop intellectual curiosity. I'd love for you to leave here with more questions than answers. It's the nature of who you are as a people, as Americans. Go figure it out. Talk to you in the spring. So, we've got low oil prices with a strong dollar, global slowdown, regardless of what you say that Europe is a contiguous economic unit. You know, it really hinges on how well is France, Germany, and Great Britain doing. France, despite the terrorist attacks, their economy is pretty good. I've often said that the United States is a B-plus country and a C-minus world economically. We are okay. And there's some other countries around the world that are okay. It's not perfect. It's never going to be. This is not some Wilsonian utopia we're dealing with here. This is real world with a lot of debt out there and social problems. But in general, you've got global challenges around the world in different continents. Federal Reserve actions have been mentioned by my colleagues. Two things I want you to consider, though, with the Fed. One is known, one is not known. First, one of the reasons they haven't raised rates is because the dollar's at all-time high. Our GDP, in general, is really hinging on three major factors. First is an economist now with Ford, as I understand, who was my professor here at Walsh College when I went through grad school and was taught by both Professor Bereiser and Professor Weglars. Professor Ballou told me that if you want to know what's really going on in the economy, the first thing you need to look at is consumer confidence. So consumer confidence is relatively good. Housing. Raw construction makes up 5% of the economy. Okay, just raw construction, putting that house up with the lumber and on what's associated. If you bring in blinds and sprinkler systems and washers and dryers, you have 20% of the economy. Autos with their suppliers is another 11%. So that's 1/3 of the US economy in 2 industries. And this is a squirrely, to use a highly technical term, a squirrely business cycle, okay? Another homework assignment I'm gonna leave you with, and you've got a few months to do it, and we'll ask when we come back in the spring. I want you to Google, because now all these movies are free, Google William Hurt plays Henry Paulson as Treasury Secretary. And it will lead you to an HBO movie which is awesome, called Too Big to Fail. All right? And I won't ruin the whole movie, but I'll kill the ending for you. Paulson is looking out his window as Treasury Secretary after all the TARP and all the stuff has been ginned up by the Bush administration to help save the economy just by printing money like crazy. He's looking out the window, and the decision has been made to give the banks close to $1 trillion, which is an enormous amount of money. And he's looking out literally in space, and he says, they'll lend the money, won't they? They will lend it. And the reason this business cycle is so prolonged and so muted is they didn't lend the money. So you're a banker that's just been wiped out. Are you going to lend it to somebody that's going to foreclose on their mortgage again? No. You're going to take the money at between 0 and 25 basis points and buy a 10-year treasury at 3%, and you have what? No risk. No risk. So housing is only now starting. If you're mildly aware of what's going on around you going to work, you see these neighborhoods literally being built out of nowhere. That has not happened since '06. And automobiles, we're going to sell 17 million units this year and 17 million units next year. The average price, the average length of a car that's owned in the United States is 11.5 years old. You give them a few more years, those things are going to be able to vote. The Fed did raise rates because of the effect on the dollar. Exports, when you look at the textbook, comprise 13% of GDP. And the stronger your currency, the more expensive your exports. That's the admitted reason they're not raising rates. The second not known reason is because of issues with the bond market. Now, many of you and many investors in the United States have what's known as index funds or ETFs, exchange-traded funds. The Fed is deathly afraid that if they raise rates 0.25% or 25 basis points, there's going to be a massive disallocation that's going to be led by high-frequency traders or hedge fund managers to get out of bonds. Many people who invest in index funds or ETFs don't know what they own. So if you raise rates 0.25%, and your bond fund, oh, bonds are safe, they're conservative, right? Your bond fund drops 1% in a day, a lot of people may sell their ETFs and their index funds, and that could create a contagion in the bond market. So they're telling you they're waiting for wage inflation and nobody's getting a raise, but there's a ton of inflation and you know it as a consumer. But consider this, yes, it's strong dollar, but the underlying reason is they're worried about the bond market locking up because of massive disallocation, especially in ETFs. Smart money leaves faster than people that are driving to work. When it comes to financial planning, we've been told that folks spend more money planning their vacation than they do their retirement. Oil prices are going to remain low. Why? Because there's plenty of product. U.S. drillers can't make money under $65. Fracking is new technology. When you look at Malthus, who predicted that we would all starve to death because the population grows exponentially and food grows only arithmetically, and he forgot what? As Professor Wigler's taught me 22 years ago, he forgot technology. So anybody ever hear of peak oil? Oh, peak oil, the sky's falling, 2009. We'll never have enough oil, we're going to be walking. Oh, really? You don't hear about peak oil anymore at all. They were wrong. They were wrong. Okay? We went from being able to produce 5 million barrels of oil in the United States to 9. The issue with fracking is that those wells are depleted 70% in the first year, about 28% in the second. So there's not a lot of shelf life there, like poking a hole in the Gulf of Mexico and the North Sea. You can't drain that reserve for long, so you got to poke new holes. So the issue is, and I wrestle with this as a professional, our industry is very big on reversion or regression to the mean with respect to returns. You know, the market's down 40%, don't sell, it ends up down 28, and it eventually recovers, so hang in there. Are we on a new normal with respect to oil? That if oil goes to $70 or $80 a barrel, they uncap those wells and keep drilling till it goes back to 40? I don't know. Low oil prices are tough on drillers, they're tough on the banks. That's why the financials are doing poorly, because a lot of these folks in the United States took loans they can't repay. That's why the financial services sectors are hurting, especially the high yield with the junk bond market, because they can't get the capital back. Good thing is, there's nothing better than low oil prices for you as a consumer, because everybody uses oil and gas. Think about the big consumers, UPS, Union Pacific, Delta Airlines. The reason you haven't got a fair cut is Delta's going to buy new planes from Boeing and Airbus. It's just fine, it creates jobs. So this is actually good news for you, but there is financial repercussions. Just touch on military operations, merit discussion. The recent events in the last week with respect to France. The Russians, our Soviet friends, are back in the game internationally. When I was a lieutenant in West Germany, Putin was a KGB agent in East Berlin. He's a former Soviet apparatchik. He believes that the Soviets were really undermined by the West, and he wants to establish or reestablish Soviet dominance in world affairs. So expect them to be very busy. And China testing the waters is a play on words. Our Chinese business partners are very, very busy in the South China Sea. They are making islands literally out of a piece of rock. They bring in literally hundreds of tons or millions of tons of concrete, and they make bases, and then they'll challenge anybody from a U.S. destroyer to a Philippine or Vietnamese boat. So our two biggest counterparties in world affairs are very, very busy. And just keep your eye on the papers and the news, because this will not go away. I want to touch on something that the political candidates are harping on, especially the Democratic Party. And they've been in power for 7 years, so in my opinion, it's no longer Bush's fault. But they say it is. He was not, the best president in the world, but as we were told as Army officers, after 90 days, if you're a company commander, it's yours. Okay, so it's yours, Mr. President. And they campaigned on income inequality, which is worse than when you took office. So, if you don't have sound money, then everything else is spurious. It's just a very unique conversation with no intellectual honesty. So if you devalue your currency every year and you print money to make the stock market goes up, who benefits? If you keep interest rates at 0%, you're not supposed to have an 85-year-old with money in the stock market to get a dividend yield, because the stock market is now the new bond market. Ben Bernanke, 5-6 years ago, wanted to chase everybody into what? Risky assets. Seriously? I thought I was a financial planner. You're the Fed chair. So you want your grandmother to sell, all of her savings and buy 16 shares of Cisco Systems? Do you think that's appropriate? And now what's happening is we stop printing money and really tighten just by the lack of monetary stimulus. Which markets are the first to correct? Emerging markets, because they represent what? The riskiest asset class, duh. Not good, not good. So for those of you who are monetarists and have studied the discipline, I don't need to harp on this, but we have followed a century policy of inflation with respect to artificial creation of credit. If you look at the History of Money by Milton Friedman and Anna Schwartz, They have tables in there that go all the way back to 1865 or so. Not until 1913 did you have demand deposits in banks. And it's checkbook money, and it is awful because you're better off printing because it can't be recreated. But when you lend money in fiduciary credit, it doubles and doubles and doubles again. When it lends, if you start with 1,000 and lend it 10 times, you have 10,000. It hurts the poor and the middle class. If you keep people poor long enough, there will be social unrest. You can't hide from this. It needs to be addressed through good public policy. Reference questions you should be asking. The question is not, why are people poor? The right question is, why aren't they wealthy? We know wages can't keep up with prices. My colleagues have gone on about that with respect to, we do have inflation, it's just not in wages. And again, interest rates have been so low, you're punishing people for saving. Here's the issue with poverty. If you're getting $20,000 in benefits, and you make $4,000 in income, you get to keep your benefits. If you make $4,001, you lose all your benefits at once. So people make a rational decision not to work. Because the opportunity cost of the extra dollar that you make when you make $4,001 is $19,999 because you've lost all your benefits at once. Unenlightened benevolence. Leave with that in your heart. Unenlightened benevolence. It's an autotom. It means that your heart's in drive and your brain's in neutral. We talk about poverty. It is increased by 3 factors. Lack of a high school education, having kids out of wedlock, and not having a permanent job. If you wait till you're married to have kids, you get an high school education, and you have permanent employment, there's a 90% probability you will never be poor. If you reverse those statistics, there's a 90% probability that you will be poor, and you will remain poor, and your children will be poor. While we're arguing, listen to these moderately intelligent people running for president. Why is that not being addressed? So if you're watching debates and you have Twitter or whatever, ask the right questions, please. There's a dearth of the right questions in the country, and it concerns me to no end. I believe Professor Fisher mentioned that unemployment is at 5%, as did Professor Weglar's. Spot on. The labor force participation rate is at 63%. There's 2 numbers that I want you to write down, 49 and 29. 49 employees and 29 hours worked. If your employer stays at those levels, they don't have to do Obamacare, and they don't have to do certain types of matching for 401ks or healthcare benefits. That's why everybody has 2 or 3 jobs and everybody's getting a 1099. Because, screens, you have the employer squeeze. Politicians take credit for creating jobs. They don't create any jobs. The public sector does not. The private sector does. So if you want to start a business, good luck. You got Starbucks, Dodd-Frank, Affordable Health Care Act for bank. You got the capital requirements under Basel III. You got to pay workman's comp. You got to pay FICA, FUTA, and SUTA. Folks from the township come through, they inventory your property, and they tax you on everything you own. You've got unions. The cost to pay an employee $60,000 is $100,000 for the employer. Your small banks and your independent doctors' practices are going out of business. And just to end on a happy note with respect to inflation, let's look at this, okay? So we talked about income inequality. This is real trouble. So when you print money, what happens? You've got a house in 1964, you could use $25,000. In 2015, that same $25,000 buys a car. If we made it to 2065, what's going to be there? Golf cart? That has to be addressed with some intellectual honesty that what they're doing is not good. And if they're not raising prices, what are they doing? But it's stronger, right? Well, you know, the 6-ounce can of tuna is now $5. If you buy salt, it used to be $8 a bag for 50 pounds. Now it's $10.50. Or the cereal box is much smaller, or you get chicken strips, it used to get 4, now it's 3, it's 2, the price is the same. Or they're using a bigger plate, or a smaller plate. Right? All right. So, U.S. economy, a guess, probably good for 2 years. We're the best house in a bad neighborhood, or the smartest kid in summer school, or a B-plus country in a C-minus world with respect to economics. Don't forget your social problems. The poor are getting poorer, that's a real problem. Got 2 references for you. Prudent economics. I had a family member out east when I got this domain name, said, "You mean that hadn't been taken?" I said, "No." He goes, "Don't you think that's a problem?" Said, "Yeah, you're right." So there's all my writings on that, a couple good charts and graphs, and then the book that we have in the back if you want. Otherwise, the book has its own website. It is on Amazon. Reviews are great, and also by people I do not know. It's a 114-page read that you'll actually read. The Great Depression, Chapter 3. My research is radically different and correct, I believe, than Milton Friedman and Ben Bernanke's. The gold standard did not cause the Great Depression. It took 15 years of research on that chapter, and the first chapter is about how we got the steel tariffs removed from the Bush administration's really poor decision as conservatives. So again, sincere thank you for coming here. You are our hope in our future. Everybody here knows, a dozen or 2 dozen people that may be of interest. Spread the websites if you want, tell them about the symposium, and do try to make a positive difference. The United States is not a perfect country, but we are a wonderful country. Thank you.